Bismillahirrahmanirrahim. We will continue with our course, that is investment and portfolio management. The course code is 531. That is about the investment and management in the portfolio. That is how we should manage to invest in the portfolio holdings and portfolio set. Reference for the study is the same as we discussed in the previous classes. That is by the Christina, conducted in 2010, and the study is about the investment analysis and portfolio management. First of all, we will discuss these summary points that we did in the last lecture. In the last lecture, we discussed the risk of the portfolio. We discussed the volatility as far as the returns is concerned for different investments and the portfolio. We discussed the measurement of the risk in the CAM model. CAM model was discussed as a asset pricing model, and we discussed the two types of risk. One was the systematic risk, and the other type of the risk is unsystematic risk. And then we discussed the assumption of the CAM model. And at the end, we discussed the market risk, that what is the market risk and how it is going to affect the portfolio of the investors, and portfolio of the investors who are deciding to keep different items, who are deciding to purchase different instruments and tools for their portfolio, and what is the market risk and how it is going to affect their portfolio. Today's lecture's contents are interpretation of the coefficient beta, that what is the coefficient beta, how we can interpret it, and how it is going to affect the returns of the portfolio. Then we will discuss the arbitrage pricing theory, abbreviated as APT theory, and then we will discuss the APT and CAMP, that what is the CAMP and what is the APT. Interpretation of the coefficient beta. We have a table to discuss the characteristics of the coefficient beta. We have 3 columns over here. We have number of rows in this. The heading of the first column is beta, that is indicating the value of the beta. The heading in the second column is indicating the direction of changes in security returns in comparison to changes in market return. That is, what is the relationship between the security returns as in comparison to the fluctuations which can occur in the market returns. And in the third column, we have interpretation in the beta. I will continue to discuss the interpretation of the coefficient beta. We have a table over here and 3 columns over here, with the help of which we are going to interpret the coefficient beta. The heading of the first column is beta. In the second column, we have the direction of the changes in security returns in comparison to the changes in the fluctuation in the market returns. The heading of the third column is interpretation of the beta meanings, that what are the meanings of the beta. And since the first column of the beta, we assume that this is going to indicate the value that the beta can carry. For example, if we have 2 to 0, if the value of the beta is 2 and 0 the same, what is the direction of changes in security returns in comparison to the changes in market returns? So we can see that the direction of the changes in security returns are the same as they are in the changes in the market returns. And what is the interpretation of the beta at this stage? We can say that the risk of security is twice as higher than the market risk. So we can say that what is the value of beta indicating, and where the value of beta is equal to 2. So if the beta carries value equal to 2, so we can say that it is indicating the risk of the security, which is if we held a security, any security J, which is twice as higher than the risk associated with the market, and the changes in the risk and changes in the return of the security which we are holding goes in the same direction as the changes in the return of the market. And second row indicate that if the value of beta is equal to 1 and 0, so what happens to the direction of the changes in security returns? Again, they are same as the market. So we can say that the returns of the security, they change in same direction as the returns in the market. And what is the interpretation of the beta in this respect? Security of the risk is risk of the security is equal to risk of the market. Then we can say if the value of the beta is 1, so both are same. the risk of the security as well as risk of the market, they are same, they are equal to each other. The third row of the beta indicate that 0 to 5, that what it shows, it also shows that the direction of the changes in security returns in comparison to changes in market returns, they move in same direction, they go in same direction. And if we analyze the third column, we see that what is the interpretation of the meaning of the beta: security risk twice lower than the market risk. It tells us that the risk associated with holding any security is twice as lower as the risk associated with the market returns. Then we have the value of the beta is equal to 0. Then what is the impact if the value of the beta is equal to 0? We see that there is no relationship. There is no relationship between the direction of the changes of the return in security and the changes in returns in the market. And third column, what third column shows, that is how we can interpret the value of the beta. Security risk are not influenced by the market risk. So we can say that the risk associated with the holding any security are not influenced, are not affected by the risk which is associated with the market. Then we move to the next rows and next discussion of the similar table. If the value of the beta is equal to minus 0 and 5, then what is the direction of the changes in returns of security and returns of the market? They move in opposite direction, the opposite from the market. We can say that the direction of changes in the return of the security is in opposite to the changes in the market returns. Then what is the interpretation of the beta? Meaning securities of risk is twice lower than the market risk, but in opposite direction. So we can say if the value of the beta is equal to minus 0 and 5, so we can say that the risk of the security is twice lower than the risk associated with the market, but they move in opposite direction. And if the next row indicates that if the value of the beta is equal to minus 1 and 0, then what happens to the direction of the changes of returns and what happens to the risk of the security and market? So we can say that the direction of the changes in security returns in comparison to changes in market return, they move in the opposite. They move in opposite directions, opposite from the market. So the security returns, the changes in opposite direction from the changes in the market returns. And the third column indicates that the security risk is equal to market risk, but in opposite direction. Then we have another column which tells us that minus 2 and 0. What is the meaning of minus 2 and 0? It tells us that opposite from the direction of changes of security returns move in opposite direction from the market returns. And as far as the interpretation of the beta is concerned, the risk of the security is twice higher than the market risk, but in opposite directions. We can say that this value of the beta tells us that the risk of the security is twice higher than the risk associated with the market, but two types of risk, they move in opposite direction. Then we have the theory which is about the arbitrage pricing theory, and this theory is indicated by APT. What this theory is and when it was emerged and who gave this theory. APT theory was proposed by Stephen S. Rose, and he presented this theory in his article The Arbitrage Theory of Capital Asset Pricing. This theory is basically about the capital asset pricing, was published in the Journal of Economic Theory in the year 1976. And still there is a positive for it, and it may sometimes displace the camp, and it has some potential. And although this theory was published in the past time, but it is still potential to guide us at the current time period as investors as far as the capital asset pricing are concerned, and it displaces sometimes the camp, which is the capital asset pricing model. As far as the cap is concerned, the return on individual assets are related to returns on market as a whole, and we can say, as we discussed in the previous lecture, that the cap discussed and cap indicated that returns on the assets held by the individual or individual assets held by the investors in their portfolio. They are linked to the returns on the market as a whole. And however, the key point behind the arbitrage pricing theory is this is a rational statement. This theory gives the rational statement as far as the capital asset pricing is concerned. The market return is determined by a number of different factors. The basic idea of the arbitrage pricing theory is that market returns are determined by a number of different factors. There are different factors, many different factors which are going to determine the market return. And these factors can be fundamental factors or statistical factors. So what is the nature of these factors? We can say that we can elaborate these factors. They can be statistical factor as well as they can be fundamental factor or the basic factor, which are likely to elaborate this theory. If these factors are essential, there to be no arbitrage opportunities. There must be restriction on investment process. So we can say, if these factors are essentially going to affect the arbitrage theory, pricing theory, we can say there is no arbitrage opportunities available, and there are, for the time being, there are restrictions which are imposed on the investment process. Arbitrage by we understand that the earning of the risk less profit. This is basically indicating the earnings of risk less profit. That is, when we undertake investment which is going to bear minimum risk, we are having the profit out of it, and this is the arbitrage. In other words, we can say that the arbitrage indicate that when we are having the profit out of the investment which is risk less. Or in other words, we can say that when we are going to decide to purchase the assets which are associated with minimum risk, definitely we are likely to have maximum benefit, we are likely to have maximum profit out of this. And this arbitrage, this type of investment or theory is known as arbitrage theory. They are taking advantage of differential pricing for same assets or the security. And another important advantage or point concerned with arbitrage theory is that the same asset or the security or the investment item can bear different prices, and we take the advantage of these different prices. And similarly, we can say that we can analyze the trends of the asset prices for the arbitrage. That what is the trend of the asset prices, in which direction the asset prices are moving and are going, and how we can analyze and how we can take a guideline of the fluctuations in the trends of the asset prices. Arbitrage is widely applied investment tactic, and it is widely applied theory that can be used widely, and in order to take the investment, in order to analyze the investment environment, and it can be used widely in order to guide the investors when they want to undertake their investment, when they decide their portfolio. And APT theory states that the expected rate of return of security is linear function. It tells us that it is linear function, and it shows one-to-one corresponding. So according to this theory, the expected rate of return is indicates a one-to-one correlation. So APT states, which is the arbitrage portfolio theory, it states that the expected rate of return of security J is the linear function from the complex economic factors, which factors are common to all securities. So we have already stated and discussed that if we invest in any portfolio which is known as any security which is the security J, and we expect certain rate of return about that security, and we have assumed that this security J has linear relationship with the economic set of factors, and these set of factors are also common to all other securities. And why it is linear? We can say that there is one-to-one correspondence between this particular security J's rate of return and the other complex economic factors. And these economic factors, they are affecting not only the expected rate of return of this particular security that we are going to purchase, or as an investor we have decided to purchase, but these economic factors are also associated with all other securities which are being traded in the market and which we can decide to purchase, and we can decide to keep them as a part of our portfolio. And we can elaborate these expected rate of returns with our with the proper equation, where on the left hand side of the equality we have expected rate of return of holding any particular security J, which is indicated by E of Rj, and this is equal to E of R bar J. On the right hand side of the equality we have the first term, which is E of Rj, R bar J, which tells us the expected rate of return of holding the security J. In other words, we can say that first term on the right hand side of the equality is indicating the expected rate of return for security J if we assume that influence of all other factors is equal to 0. In other words, we can say that keeping the effect of all other factors equal to 0 or equal to constant, what is the impact of this particular first term? So this particular first term on the right hand side tells us the expected rate of return for purchasing the security J. And we have number of other factors included in our portfolio. For example, what I1J indicates, Ij indicates that the change in the rate of return for security J influenced by economic factor I. For example, if we have chosen any and we have selected any particular factor I, which is the economic factor, then what is the impact of the change in that economic factor on the rate of return of the security J? And we assume that these economic factors goes up to nth, and we have one by one we have the impact of these different factors on the rate of return for holding the security J, or we can say that what is the impact of all these factors on holding the security J, and beta Ij is the coefficient beta. This shows the sensitivity of rate of return on security J due to the factor I. That what is the effect of holding any factor J, which is factor I, which is the economic factor on the rate of return of the holding factor J. For example, if we write this here, we can say that expected R of J, expected value of R of J tells us that expected rate of return of holding any particular stock J is equal to expected value of R bar J, which is the mean value of holding the stock J for some time period, plus beta Ij into Iij. This basically tells us beta Ij indicates the coefficient beta. This tells us that what is the impact of change in any economic factor I on the change in the rate of return of holding the stock J. And we can, and definitely Iij is same, indicating that we have economic factor I's, and the value of the I starts from I to n, and we can rewrite this equation in another form. For example, we can write it as the expected value of Rj. This is the expected rate of return of holding any particular stock J is equal to expected mean value of holding that particular stock J plus sum of beta Ij into we can say Iij. What this tells us, this relationship tells us that this is the mean value of the rate of return by holding any particular stock J, and the second term indicates the sum of all these, where I starts from 1 and it is up to n, and beta Ij is basically the coefficient beta, which is the slope term. It is also known as the slope term. It is also known as the rate of return. It can be known as rate of return in the returns of rate of it is basically known as the rate of change in the returns of stock J, due to change in the in other factors which are known as II, capital II. So we can say this is the slope which shows the rate of change in the returns of the particular stock J that we are holding due to change in the holding of other economic factors, for example, which are indicated by capital I, and the number of these start from 1 and ends up to n. So we can say that this is the sensitivity factor. Beta is the slope, it is the rate of change in dependent variable due to change in the independent variable. It is, again I repeat my word, that beta Aj is the coefficient beta. It shows the sensitivity of rate of return on security J due to factor I, and influence could be positive or negative. We can say the coefficient of beta, it can be positive, it can be negative also. It depends upon the data, it depends upon the trend of the association between this particular security J and the other economic sectors which are prevailing. Theory can determine and theory can guide us in this respect, in respect of relationships of the particular security J and the other economic factors, and then the empirical studies and the implication of data can also guide us about the relationship between the particular stock J and the other economic factors which are indicated by capital I. So we can say that beta Ij indicates the sensitivity, it is the slope coefficient, it is the rate of change in dependent variable Y due to change in independent variable X. So it is the rate of change, or Y is basically the security J, change in return of security J that we are holding. And what is this? This is basically the change in holding of I factor. And these I factors are the economic factors which start from 1 and they end up at n. That is why in this formula we have applied that I starts from 1, its value ranges from 1 and it ends up to nth. We move to the next slide. What is the EJ, which is the last term on the equation, and we have indicated this by EJ, or can be known as eta J. What is EJ? EJ is basically the error of rounding for the security J, or it tells that expected value is equal to, and it basically gives the difference between the actual and the mean value. So error J is the residual. The value of this error is also known as residual value. What this residual value is, that for example, if we assume that the mean value is this, or the expected value of Rj is this, and we can say that this is fitted, this is the line which is fitted to the data, or best fitted to the data. It can be known as the regression line, which is indicating the relationship between the number of independent variables and dependent variables. If we have actual observations here, and this is the mean value of R, and we have actual observation here, the difference of these actual observations of the returns from the mean value from this line is known as residual, and give the error, and can be known as error. The value of error can be positive and error can be a negative value. For example, if the actual value of the R is greater than stock for the stock J is greater than the mean value of returns for the stock J, so error be a positive value. And if we say that the actual value of returns, expected returns for a particular stock J is less than mean value of the rate of returns for the particular stock J, so we can say the error is bearing negative value. And when these positive and negative errors, they adjust with each other, and they are adjusted and they compensate each other, so we can say that we have mean error equal to 0. So over R value of error is equal to 0, and also the sum of error I is equal to 0. So it is important to note that arbitrage in the APT theory is only approximate value. This is the approximate value relating diversified portfolio, and it tells us arbitrage. We can say that in our APT theory, arbitrage pricing theory, we have a number of securities included, and in other words we can say that we have a number of items included in our portfolio. So therefore we can say that this is the diversified portfolio, or it is confronted with, or it is bearing a variety of assets in it, and therefore we can have the benefit of, we can enjoy the benefit of a variety of assets in and securities and items present in our portfolio, and therefore the risk, if there is a risk associated with these items, with these securities and assets which are present in our diversified portfolio, so the risk can be managed and the different risks can compensate each other, and we end up with the minimum risk. Therefore this is the important and interesting point of the APT theory. This is the plus point of the APT theory. The asset and then you can say it is based on the assumption, the APT theory is based on the assumption that the asset unsystematic risk are negligible compared with the factor risk. That is when we have the factor risk associated, that is there are the risks which are associated with the factors. Or what are these factors? These are the economic factors, which we have discussed that they are going to affect the rate of return associated with particular security J that we are deciding to purchase, that we have decided to purchase, and this is different from the unsystematic risk or any other specific risk. We continue with the discussion that there could be infinite number of the factors, although empirical research by Ross and Roll conducted in 1984 identified only 4 factors. So we can say that according to APT theory, asset pricing theory, what are the benefits, what are the plus point and feature of this theory is that we have a number of assets included, we have number of items, or in other words we can say securities in our portfolio. So we can say that our portfolio is diversified portfolio. We can enjoy this important feature of our portfolio, that it is diversified, and we can lead to the minimum risk. And in other words we can say that number of economic factors, number of other factors can affect our portfolio. One thing is that if we have portfolio 1, P1 indicated by P1 is equal to different assets, asset A and item B is present in P1, portfolio 1, C is present in this portfolio. We have another portfolio P2 where we have A1, B1, C1. All these are the parts of the portfolio. We have already discussed that these portfolio items are interrelated with each other. We should be careful, we should have the knowledge that what type of relationship exists between these different items of our portfolio, that what type of relationships exist, or is there any relationship which exists between these portfolio. One thing we can say that returns of one asset present in our portfolio and return of one security in our portfolio is affecting the return of the other security. And under the light of this environment, we can, as an investor, we can decide the items to be present, to be purchased for our portfolio. This is the one important thing. The other important thing is that there are the other factors which are likely to affect these items, which are likely to affect these securities and these assets which are present in our portfolio. So therefore we can say there are 2 types of important effects which are going to affect our portfolio holdings, which are going to affect our purchases and our decisions about the purchasing of the portfolio items. So we can say there are number of the factors which can affect the items present in our portfolio. And although the Ross and Roll identified only 4 factors by their study conducted in 1984. And what are these factors? They ask these factors economic factors. According to them, these are also economic factors which are going to affect the return of these items present in our portfolio. And as a result, and under the situation of this type of analysis, we can be guided, and as an investor we can be guided to make the specific purchases and specific selection about our portfolio items. And what are these economic factors? Economic variables to which assets having even the same cost and capital asset pricing model beta are differently sensitive. So if we can say, even we have the same portfolio, but the beta can differently, beta associated with these economic factors can affect these assets in the portfolio in a different way. What are these factors? First is the inflation. First economic factor which is going to affect the items present in our portfolio, or the items that we have decided to purchase for our portfolio, is the inflation rate. That the rate of increase or growth rate of the prices of the items prevailing in the economy, growth rate of the prices of the goods and services prevailing in the economy is going to affect our portfolio items and the returns of our portfolio items, and consequently our decision about the selection of portfolio items in the financial market. The first important factor is the inflation rate. And what is the second important factor? Second important factor is the industrial production. What is industrial production? Definitely our economy and the strength of our economy, the worth of our economy depends upon the production. If we are going to undertake the real production, we are going to undertake the physical production, we go through the process of physical production, the economy will be able to produce more, will be able to have higher level of productivity, and will be able to provide the high standards of living to the factors of production and to the population as a whole. We can say the production is another important factor which is going to affect the returns of the assets and returns of the items present in our portfolio, and whether the production level is at a higher level. In other words, we can say, if the economy and industry is producing higher level of output, how this higher level of output is going to affect the items present in our portfolio. And on the other hand, if the production is at lower level, how the production in our economy is likely to affect the rate of return of the assets present in our portfolio. Then third is the risk premium. That what is the risk premium which is associated with with this type of production, that how the risk premium is affecting the level of production. And then the slope of the term structure in interest rate. That interest rate is an important term structure. How is the slope of the interest rate? That is how the rate of interest is going to affect our returns in securities, our returns of the items or the assets that we have kept as a portfolio. So we can say all these economic factors. The first important factor is the inflation rate, second economic factor is industrial production, third economic factor is risk premium, the fourth economic factor is the rate of interest. For example, if we look at the inflation rate, it is the rate of growth of the prices of goods and services which are prevailing in economy, or which are being purchased and sold, and which are being demanded and produced in the economy. Second is the quantity. In other words, we can say quantity of the goods and services which are being produced. तो अगर ये quantity जो है वो कम है, if it is less, अगर ये कम है, तो how it is affecting the returns of portfolio. और ये quantity अगर surplus में है, how it is affecting the returns of the stock J in our portfolio. And how the risk premium is affecting, how the rate of interest is affecting, because the risk premium is associated with the investment level. Also it is associated with the financial investment, or it is also associated with the physical or the real investment. And thirdly, we can say the rate of interest. Rate of interest is also associated with the financial investment in financial market, and also it is associated with the real investment in the productivity sector. And we can say that these are the important economic factors which are going to affect the level of investment, which are going to affect the returns of investment being kept in our portfolio, and consequently our decision about the selection, about the choice of different items, different instruments, different tools, and different security that we are going to keep and we are going to purchase to make them as a part of our portfolio. Continuing with the same arbitrage theory, we can say that in practice an investor can choose the macroeconomic factors which seem important and related with the expected rate of return of any particular asset. That is, we can choose and we can identify which factors are likely to affect the returns of any particular assets that we are going to choose and we are going to keep in our portfolio. For example, it is the security J, it is the item J, it can be the instrument J. What we are going to do as far as our choice, as far as our investment in the items of portfolio is concerned, we should identify the macroeconomic variables which are likely to have impact on the returns of our specific choices of the assets and of the securities. Or when we talk about the relationship, when we talk about the association of the economic factors and the security J, so what type of relationship, whether these economic factors affect the return negatively, in negative way, that is they reduce the rate of return of the stock J, और पॉजिटिवली या ये रेट ऑफ रिटर्न को पॉजिटिवली इंक्रीज करते हैं, ये ऊपर की तरफ मूव करता है. फॉर एग्जांपल, इफ वी हैव मैक्रो इकोनॉमिक वेरिएबल ओवर हियर एंड वी हैव द रिटर्न्स ऑफ द जे ओवर हियर, अगर ये इकोनॉमी में आते हैं और if we are using these factors and if there are fluctuations in these macroeconomic factors, तो return on the J जो है बढ़ता है या इसका negative relationship है, as we have indicated in this diagram. The examples of possible macroeconomic factors which could be included in the APT model are: what are the examples, what are the important possible macroeconomic factors which we can use as a part of our choice, as a part of our set to identify the possible relationship between these variables and which are working and functioning in the economy of the country and the assets or the security that we are deciding to make them as a part of our portfolio. First important is GDP growth, which is the important economic variable. In other words, the performance of the economy, the function of the economy depend upon GDP growth rate. Whether our GDP is growing or not. And what is GDP? GDP is gross domestic product, or we can define it as that it indicates the value of total market value of all the goods and services which are produced within the boundaries of a country by the domestic resources. And जो भी resources domestic boundaries में आ जाते हैं, whether they are national or they are international, but they are working within the boundaries of our country, वो हमारे मुल्क की बाउंड्रीज के अंदर काम कर रहे हैं, they are playing their role in the production function of our economy, वो हमारी कंट्री के प्रोडक्शन फंक्शन में काम कर रहे हैं, they determine the gross domestic product जिसको हम GDP कहते हैं. तो what is the growth rate, इसका क्या ग्रोथ रेट है, क्या इसकी इंक्रीज हो रही है, ये कम हो रहा है विद द पैसेज ऑफ टाइम या ओवर द फिजिकल ईयर्स, एक साल से दूसरे साल के दौरान में हमारा जीडीपी ग्रोथ रेट जो है वो कम हुआ है या ये बढ़ा है. दिस इफेक्ट the performance of the financial market, this affect the investment prevailing in the financial market. Definitely our economy, if our economy is strong, if our economy is strength and it has higher physical productivity, that is if it has higher GDP growth rate, we can say we have higher productivity available to us as a factor of production, we have higher productivity available to us as a people of the country, we can improve our standards of living, we can consume better goods and services, and we can save a lot. And what we say, we can invest our savings. Definitely when we have plenty of money and resources to save and to spend in the financial market, the situation prevailing in the financial market will be definitely different. And we can say that in this respect, in this way, we can go to strengthen the situation of our financial market. We can go to have the good portfolio holdings, we can have the good items in the portfolio, and definitely the assets prevailing in the and being traded in the financial market, they will perform better and they will show good returns, because when we have economic stability in the country and the economic variables, they are showing the positive behavior, they are showing the strong and stable behavior, so we can find a good and stable environment as far as the financial market is concerned, and we can expect to have high returns from the investment in the financial assets, and can have better assets in our portfolio. And then interest rate, we know that as far as the investment is concerned, interest rate affect our investment. It affects our investment as a depositors, as a purchasers of the saving accounts and saving certificates, and also as a borrowers. If we are borrower and we borrow the money to invest, so we can say we have two type of behavior over here, which can be affected by the fluctuations in the rate of return, which can be affected by the changes in the rate of return. Then exchange rate determine our relationship with the international market. फॉरेन मार्केट के साथ ये हमारा रिलेशनशिप इंडिकेट करता है. एंड स्प्रेड एंड डिफॉल्ट स्प्रेड ऑन द कॉर्पोरेट बॉन्ड्स इज अनदर फैक्टर कि जो डिफॉल्ट स्प्रेड है कॉर्पोरेट बॉन्ड्स में, इट कैन आल्सो इफेक्ट आवर बिहेवियर ऑफ making purchasing and our behavior of making sale in the financial market. So we can say that all these economic factors, they play an important role, they play a significant role in the financial market, and we can have better choices in the financial market. We can have better decisions as far as the portfolio items are concerned, as far as the securities and assets that we can keep in our portfolio set are concerned. And the overall situation in the reality and in the real sector, that is physical production sector, and in the financial sector will appear in the country. Continuing with the similar topic, we can say that including more factors in APT model seems logical. So this tells us that we can include a number of factors in our APT model, which are macroeconomic factors which can affect our portfolio holdings, which can affect our items which we are going to keep in our portfolio. Therefore, we can say institutional factors, besides being the individual investors, we have institutional investors as well, and institutional investors and analysts closely watch macroeconomic statistics such as money supply. Institutional investors and investors in a group, they analyze the situation by the, for example, money supply. What is the money supply in the country? अगर money supply बढ़ती है, we can say we have more money to spend. We have more money to spend. और जब हमारे पास बहुत ज़्यादा money होती है कंज्यूम करने के लिए, वी हैव मोर मनी टू सेव, हम ज़्यादा पैसे सेव करते हैं, हमें ज़्यादा पैसे को वी कैन इन्वेस्ट दिस मनी इन दी फाइनेंशियल मार्केट. हम इसको फाइनेंशियल मार्केट में इन्वेस्ट भी करते हैं, और हम इसको फिजिकल या रियल सेक्टर में भी इन्वेस्ट करते हैं. तो इन्वेस्टमेंट इन रियल सेक्टर जो है वो भी इंक्रीज करती है, और फाइनेंशियल सेक्टर में भी एंड फाइनेंशियल मार्केट में भी इन्वेस्टमेंट इंक्रीज करती है. वन मोर थिंग इज कि जब मनी सप्लाई बढ़ती है तो रेट ऑफ इंटरेस्ट जो होता है, जिसको हम आर से इंडिकेट करते हैं, ये कम हो जाता है, और बोरोइंग जो है वो चीप हो जाती है. इन दिस केस वी कैन से कि बोरोइंग जो है वो चीप है, और वी हैव more funds to be borrowed. We can borrow the funds in a cheaper way. We will have to pay less for our borrowings, and और इसका रिजल्ट क्या निकलता है कि लेवल ऑफ इन्वेस्टमेंट, जिसको हम रियल इन्वेस्टमेंट कहते हैं, वो इंक्रीज कर जाती है. इसकी वजह से हमारा प्रोडक्शन जो है वो बढ़ता है, जिसको हम वाई से इंक्रीज करते हैं, इंडिकेट करते हैं. जब ये प्रोडक्शन बढ़ता है, हमारा कंजम्पशन बढ़ता है, जिसको हम सी से इंडिकेट करते हैं, हमारा सेविंग बढ़ता है, जिसको हम एस से इंडिकेट करते हैं. और वी कैन से कि हमारी अगेन फिजिकल जो इन्वेस्टमेंट है वो बढ़ती है, और इन्वेस्टमेंट इन फाइनेंशियल मार्केट जो है वो बढ़ती है. तो वी कैन से द सर्कुलर फ्लो ऑफ इनकम जो है वो चलता रहता है इस तरह से, और वी विल बी एबल टू अर्न मोर. As far we will be able to improve the economic situation, we will be able to produce more in the country, and we will have better situation. For example, if productivity is high and we will consume more, we will save more, and we will invest definitely more, and we will again produce more. Invest, what is the investment? Invest in the real sector and invest in the financial assets. और फाइनेंशियल एसेट्स में भी हम जो है वो इन्वेस्ट करते हैं. अनएम्प्लॉयमेंट इसकी वजह से कम हो जाती है और लोगों को नौकरियां मिलती हैं. जब प्रोडक्शन बढ़ती है जीडीपी जो है वो हमारा बढ़ जाता है और पॉलिटिकल स्टेबिलिटी जो होती है वो भी इकोनॉमी में आती है. वी कैन से दैट ऑल दीज फैक्टर्स इफेक्ट द रेट ऑफ रिटर्न, all these factors affect the rate of return in a positive manner. In a positive manner, they help to strengthen the situation for investment in the financial market. And एक एक फैक्टर जो है वो फाइनेंशियल मार्केट को इंडिविजुअली इफेक्ट करता है. एंड इफ वी मेक ए चेंज फ्रॉम ऑल दीज फैक्टर्स कलेक्टिवली, that is how we can say in aggregate how these factors are going to affect the situation in the financial markets, how these factors are going to positively affect how these factors are through their function are going to strengthen the investment environment in the financial market. So we can look at the circular flow of income, जिसको हमने इंडिकेट किया. सर्कुलर फ्लो ऑफ इनकम का मतलब है प्रोडक्टिविटी जब बढ़ती है तो पूरे मुल्क की हालात जो है वो बेहतर हो जाती है. वी कैन इम्प्रूव द स्टैंडर्ड ऑफ लिविंग. और प्रोडक्टिविटी का मतलब है जीडीपी, और जीडीपी शोज के ग्रॉस डोमेस्टिक प्रोडक्ट के. ग्रॉस डोमेस्टिक प्रोडक्ट जब बढ़ती है तो वो क्या इंडिकेट करती है, उसकी क्या सिचुएशन होती है, और हाउ वी कैन एनालाइज the environment with respect to investment in financial market and with respect to the investment in the physical market. And we can say what are the reasons behind this new information about the changes in these macroeconomic indicator will influence future asset pricing movement जो है उनको भी हम assess कर सकते हैं. और we can point out कि not all the investors are concerned with the same set of economic information. सारे इन्वेस्टर्स जो हैं वो एक ही तरह की इंफॉर्मेशन के साथ कंसर्न नहीं होते उनके, बिकॉज दे हैव डिफरेंट पोर्टफोलियोज. और डिफरेंट पोर्टफोलियो जो होते हैं उनमें के पोर्टफोलियो आइटम जो होते हैं दे आर इन्फ्लुएंस्ड बाय डिफरेंट फैक्टर्स. Some factors influence some time of portfolio items, and the other factors, economic factors, influence other type of returns on the portfolio items. However, we can say that in overall, because all the assets which are prevailing and being purchased and sale and which are being traded in the financial market, they are linked with the economic sector, they are linked with the economy and political sector. Therefore, we can say that as a conclusion, all these factors, economic factors, they are likely to influence, and all the political factors, they are likely to influence the items present in our portfolio. And if the economic stability is prevailing in the economy, we are likely to have the stable environment in the investment of the financial assets and financial market. If political economy is stable, political environment is stable, we are likely to have the stable environment of the investment in the financial asset. And that's it. This is the today's lecture, and at the end I will provide the summary of the lecture, that what we discussed in this. We discussed the coefficient beta and significance of coefficient beta as far as the returns of different assets is concerned, that on which we are going to invest and we are going to keep them in our portfolio. So basically beta coefficient indicate the slope and rate of change of the dependent variable, or in other words returns on particular asset due to the changes in the return of the market portfolio, and direction of the relationship. Then we can see that we discussed the arbitrage pricing theory, and we discussed the important points of the arbitrage pricing theory, and we say that it is very much important theory, and it gives us determine a number of different factors, and can say that there are number of economic factors which can influence the particular portfolio items of the individual. So beside discussing the interrelationship of the items, interrelationship of the assets, and the securities being kept in our portfolio, we should discuss the other economic factors, external economic factors, which are going to affect the items and the returns on the assets, return on the securities which are present in our portfolio. And therefore this is the additional point that the arbitrage pricing theory pointed out, and basically provide us a guideline in this respect, that how the economic factors and how the political factors they can affect the economic situation and stability of and environment of the investment in the financial market, and also tell us that what is the expected rate of return being affected and how it is being affected by the rate of return of all other factors that are present in our portfolio and the returns of other economic factors. And told that beta is basically indicating the sensitivity of the returns, and also pointed out, discussed different macroeconomic variables. Among them we have important variables: inflation, GDP growth rate is important, rate of interest is important, exchange rate is important, and we have the risk premium is important, and the productivity is another important variable which may affect, and political factors are also there which can affect the returns of investment in any particular security or the bond or the stock. This was the 2 days lecture, and I hope that you have understood the point, and this discussion will give you a guideline and proper value during your self study, and you will better understand your concept with the help of these slides, with the help of this discussion and the reference material that is given here. And inshallah we will continue the similar topic in the next class, and take care of yourself. See you in next class inshallah. Allah Hafiz. Assalamu alaikum.